Hello, this is Daniel Want from Prerequisite Capital Management. Today we're going to briefly discuss some of the main elements in this latest quarterly briefing that we just put out. Of course, this is general information only and should not be considered specific advice, and past performance is not necessarily indicative of future performance. So in this quarterly letter, really we're summarizing a lot of the key themes and issues that we've been writing about both in past quarterly letters last year, which we'd recommend that people would review, and also in our subscription-only PCS reports, which go into a lot more detail. So in just updating general growth and inflation conditions in the world, obviously this is sort of symptomatic of more broadly what's happening, particularly the sort of record levels of activity that appear to be happening in the world, at least at a surface level. But obviously when we look beneath the surface, we typically find in most areas of the economic system, the quality of this growth is definitely found lacking. Also, it's probably worth noticing that this is symptomatic largely of coincident indicators when we actually look at more typical leading indicators in the world. So this in the blue here is a composite of leading indicators of, a lot of the main regions of the world that kind of matter in terms of global economic growth. We can largely see that we're hooking down already. And so this peaked at the beginning of Q4 last year. Every time this is hooked down in the past typically means we're in the vicinity of a topping condition in the subcycle of global growth. And anytime you see these sort of topping or peaking type conditions in the more coincident growth metrics, shown here by the US PMI, is sort of indicative of that broader array of data sets. It's typically attractive times to be owning large quantities of US treasuries. And so it appears like we're at that point again. And when we look at the pessimism towards US Treasury bonds in particular, we're definitely sort of revisiting areas that in the past, at least historically over the last few decades, although it's not shown on this chart, have been very attractive positions, both from a sentiment and positioning point of view, to be owning large quantities of longer duration Treasury bonds. Obviously, there's a lot of hype at the moment around the inflationary potential of different government policies and a potential shift in the broader regime out there. Obviously, in this letter, we sort of work through some of the issues, and especially in light of the quarterly letters that we published last year, we've tried to provide basically a common sense overview that helps us to see through some of the poor thinking around what drives inflation and what the prospects are for inflation over the short, medium and longer terms. Obviously, we'd recommend going into some of our PCS reports in more detail, particularly the PCS 56 report, and some of the more later, or some of the latest ones we've also released that really go into these things in much more details, and obviously the first principles reports, particularly PCS 27, where we really go into great depth and just exactly how inflation comes about, what it is, what drives it, both at sort of cyclical and also structural levels. And that kind of helps us to just see through largely the poor thinking around what is unfolding in the broader system and what that means from an inflation-deflation point of view. This chart at the top here just simply shows the US inflation rate, or the headline CPI inflation rate, also the break-even inflation expectations priced into US bond markets, but also showing the one of the main commodity indices, just kind of showing the coincident/leading relationship of this. This is just one way of looking at where we might be from an inflation point of view. And that will make sense in this subsequent chart where we kind of identify that we're potentially at a topping sort of condition from a commodities point of view, which would be consistent with growth potentially peaking, at least in this subcycle. And then so that basically implies that we're coming up to or close to a peak in both the inflation expectations and potentially, or a little bit after, the CPI headline rates peaking as well. Obviously, the last 12 months we've seen a ridiculous stampede into all forms of inflation assets or inflation-related type exposures in markets. And when we look at our measures, particularly of money flows, speculative flows, and even patient money capital behavior, we're at levels that are over-speculative, that have typically been coincident to topping sort of conditions in the broader index. We also have patient money distribution, which also increases the probabilities that we're actually seeing a reasonably significant intermediate top in commodities, which also is suggestive of a topping condition in the sub-cycle of inflation expectations and even CPI prints in the world. Obviously, we have a little bit of a US-centric focus here on the inflation discussion, but a lot of this is reasonably symptomatic of what we're seeing around the world. When we relate this back, so we're kind of at a higher probability of a topping condition in commodities, and when we relate the commodities back to the treasury bond market, you can see that each time the commodity sort of markets have topped in the manner that we identified previously, that typically represents a pretty significant opportunity to be owning longer duration treasuries, as shown here by the TLT total return index for the TLT ETF that trades in the States. So once again, we sort of have a myriad of different ways of looking at what is unfolding in the world, both from a growth and inflation point of view. And although this quarterly letter really is just a summary of broader issues or broader models and frameworks that we run, and issues that we've been writing about in the PCS reports in particular, they're all basically painting similar sort of underlying pictures as to what's going on. And so those sorts of setups suggest that the bull market in the US dollar on a multi-year sort of time horizon is still not over, and the bear market in the Australian dollar in particular is also well and truly still intact. So that puts this recent bounce in a tactically corrective category, and we'd expect the broader multi-year downtrend in the Australian dollar to continue. Or if we flip that on its head, the multi-year uptrend in the US dollar to also continue as well. We've recently put out a PCS report in the last month or two on capital flows in the world and a lot of the different models around analyzing different currencies. And so once again, if you want more information, we recommend you talk to us about the PCS reports. Now, in the last 12 months, we've seen once again another fairly intense influx into risk assets in the world. It seems to be a lot of, the animal spirits are actually are riding pretty high when it comes to risk assets more generally. And so here we look at the global stock market, excluding the US, and we can see an over-speculative condition and really poor or unconfirming sort of underlying liquidity conditions. And that typically would mean that this is a fairly weak condition in global equities as a sort of barometer of broader global risk assets. Similar times you get these over-speculative conditions, and diverging and lethargic underlying liquidity conditions have typically marked reasonable or intermediate tops in global risk assets. Now, obviously, we've kind of made the point in previous quarterly letters and definitely the PCS reports that the conditions are still in place for overall multi-year US equity market outperformance of the rest of the world. So any corrections or washouts in equity markets in the world, we still anticipate that US equities will be more resilient overall. In looking at what is going on in the world, especially in the last decade or so, but even over the last year, the common theme is that we progressively are seeing a deterioration in real economic activity more pressured standards of living in most regions of the world. We have an overly financialized economic system globally and in most of the regions of the world that kind of matter from a broader market economic and investment point of view. And so there's a myriad of different ways of seeing this, and using, say, a US-centric point of view. These are a few different ways to just profile or symptomatic of that deterioration in real economic activity and output, whether you're looking at employment or labor market conditions, the productivity or velocity of money, and the productivity of debt and any new credit in the US and around the world continues to generate less and less economic result. This is a very lethargic sort of condition, and when you deflate risk assets and financial assets by the central banking balance sheets, you typically see basically a similar pattern of deterioration and an implied real economic activity and real situation deterioration. Really, when we're deflating risk assets or financial assets by central banks, we really need to also be including real estate in addition to share market valuations. Probably should include some other asset classes as well, but overall, even here for Australia, we can see the total value of real estate, like all property in Australia and Australia's share market, and we deflate that by the RBA's total assets, so our central bank's total assets. You can kind of see this deterioration, especially even the last 12 months. We've hardly even bounced, where we've seen a massive run up in sort of an artificial capital or illusory liquidity sort of created by each nation's central banks. There's no coincidence that even here, this measure of the Australian share market market capitalization deflated by the RBA's total assets. There's no coincidence that there's a reasonably tight degree of correlation overall between essentially our economic conditions and the broader rates of return in our economy as reflected by bond yields and the deflated performance of, so in this case, the market capitalization of Australia's share market by the central banking assets. We sort of discussed that briefly in this particular quarterly letter, and so I'd suggest you sort of dive into that and have a little bit of a think about some of the perspectives that we're presenting here about what yields represent and also what is going on at a real level around the world. And of course, this deterioration in the quality of economic activity is a real problem. And we're kind of trapped in this feedback loop where the more conditions deteriorate or remain sluggish or remain even unstable, especially if we get a bout of stress in the system, the more our governments and central banks will act. And the larger their footprint, the more that suspends market mechanisms and a variety of different things, and the more that actually guarantees even increased instability and greater economic sluggishness and pressures on living standards moving forward. And unfortunately, I don't know what's going to really break that feedback loop, at least in the short to medium term. And so this trend towards sluggish growth and any increases or sub-cycle increases in growth are likely to prove more transitory than self-sustaining, at least for the foreseeable future or short to medium term, which is, it's not ideal, that's for sure, but it just means that we need to be a little bit more aware of the sub-cycles of growth and reflation that tend to occur in the world every 1 to 4 years, roughly. If anything, this would suggest that these sub-cycles are probably going to increase in frequency, but they'll remain transitory. And so every time we get a draft blow through the world of weakening growth and disinflationary or deflationary tendencies in that weakening growth, we just need to be a little bit mindful that this is happening in the context of a fairly fragile and over-indebted system. So each time we get the downdraft in these sub-cycles, we just need to be quite aware as to what is going on, and just making sure that we're not seeing any reflexive and negative feedback loops being crystallized. That can take a negative draft into and turn it into a crisis pretty quickly. So just to summarize this particular quarterly letter, it's fairly plain that we're at a high probability of seeing both growth and inflation peaking presently and stalling out and rolling over for the remainder of this year. That would tend to be very bullish and positive for US dollars and also longer duration US Treasury bonds and similar sort of exposures. There's some storm clouds gathering over risk assets, at least at a tactical shorter term level. The rally or the reflationary growth bounce over the last 12 months, in particular subsequent to the volatility shock back in last March as everything really closed down, has extended much more. That rally or that corrective rally within the broader conditions has been much more pronounced than we were expecting, and so that's obviously deepened the drawdown in our portfolios, but we view that as a natural part of the strategy cycle, as most of the strategic investment trends that we tend to align our portfolios with are well and truly intact and gathering pace. Obviously now we have the benefit of the last 12 months of data, and we can see the growth and reflationary resurgence is built on a really poor quality foundation, and we're already seeing the signs of it rolling over. And so we would expect, as a short-term consequence, yields, although they've moved up a little bit, that they will start to decline. So that's bond price bullish. This rally in the Australian dollar and commodities in general will tend to prove quite transitory, and as the rest of this year unfolds and into early next year, we'd imagine or at least these different models and some of our broader frameworks are suggesting the strategic trends in most of these markets are likely to continue and persist. We are also expecting the outperformance of the US equity markets in general to also persist, as those broader multi-year capital flow dynamics and even financial system dynamics in the world are well and truly intact, and if anything gathering pace. So it'll be an interesting year or two ahead, particularly given that right now markets and most different capital markets around the world, whether it be commodities, currencies, equities and bonds, they're all so heavily over-positioned towards that reflationary growth thesis and narrative that has really gone to an extreme over the last 5-6 months in particular. And so that's a bit of a vulnerable condition for the rest of the year for most capital markets to be in, because we have a positioning and mismatch with the unfolding of underlying conditions. So it'll be intriguing to watch, but needless to say, although it's been quite uncomfortable over the last 12 months, having to sit through a correction in the broader strategic trends that we're aligned with in our portfolios, we're actually quite comfortable now, having the benefit of watching the way the data and different information and broader underlying conditions have evolved in the world. Quite comfortable that our positioning should be well rewarded, and our patience over the last 12 months will be well rewarded in the next couple of years moving forward. So this has been Daniel Want for Prerequisite Capital Management.